everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So, what are we talking about? Well, for Mind the Trade, aka Trading Psychology, I want to do an introduction to managing fear and expectations. And that's sort of a gentle introduction to some of the neurology that's involved in trading and also, obviously, the trading psychology. For the methodology in action, I want to talk about an open position. We just have one. And I want to talk about the better than a poke and the eye trade. And the secret of trading is getting enough of those poke in the eye trades to where you occasionally catch something that's much, much longer. That'll make more sense in just 1 second. Housekeeping, I do take requests. It makes my job a lot easier. You can send them to davelandry.com/contact. Or if you would like your question answered live, still send it to me, but if you want it answered live, you can go to davelandry.com/webinar and register for the weekend charts. If you go to the slides on this presentation, all the other presentations combined, including a lot of other stuff, all three of my books in PDF format, limited access to the members area, a market timing course, and so on and so forth, go to davelandry.com/StockCharts. If you need to reach me on Twitter, at TFollowingMoron. And by the way, YouTube is at Dave Landry. All right, let's talk about the mystery charts and the methodology in action. So here's MBLY. This stock, you can see, was in a pretty good uptrend. It began to pull back, and the parameters were just shown on the spreadsheet. Entry here, stop down here, initial profit target up here. Now, on that opening gap reversal day, I actually used a little discretion, and I did not enter the stock, but I did get in a little bit later, as you can see here. Also, there was an S&G trade, which I talked about in my Facebook group. I was looking to get a large position off in some short-dated options, and I was only able to get about 5 of them off at a price that I was willing to agree to. But that's another conversation in and of itself. Anyway, the second entry I took on this was I waited for this thing to re-trigger, so to speak, by taking out this little prior high in here. So that's my actual entry on it. You can see 42.99. Now, let's take a look at VTS. Here's another stock that I recommended recently. I'm not sure if this was a mystery chart or not. But you can see the parameters down there in the spreadsheet. Nice uptrend. Also was an IPO that came public, bottomed out, and then began to take off. So we're playing that first pullback in an IPO, which could be a great pattern to play. Entry was there. Once again, kind of an opening gap reversal type of situation. And on this one, I also took a second entry. You can see there's my entry there, getting in a little bit higher than the trading service. And upon the exit, I went ahead and exited just a tiny bit early on that one. So I used a little bit of discretion, and that's exiting only on half of the position. Now, when that happens, we bring our stop up to break even. We will trail before that initial profit target is hit, but once it's hit, even if it's hit intraday, the stop immediately comes up to break even. We've talked about trailing stops before, so I won't get into that too much. Now, following up on this, unfortunately, it looked like it was a takeoff, but then it came right back in and stopped out. So, followed mechanically in the trading service, you would have made $9.58 on the first loaf and nothing on the second. Now, here are my actual trades down there. Let's add it all up. 20.30 minus 18.37. So, right about 2 points on the trade, a little bit less, obviously, times 500 shares equals a profit of $9.65. I was looking for roughly about $1,000 on the first loaf. On the second loaf, I let it come in a little bit past the stop, applying a little bit of discretion, and I ended up losing $235. Overall, and this is one thing you need to make sure, you want to make sure you capture the lion's share for what I call the better than the poke and the eye trade. Now, as I alluded to earlier, the secret to trading is position yourself to where you're able to at least get the initial profit target out of the position, and at worst, stopping at a break even or remain. Obviously, there's going to be some outright losses, and you've seen quite a few from me in fairly recent times. But if you could occasionally get to this poke in the eye trade where you're taking those partial profits, and if you get enough of these, eventually you're going to catch a huge winner. And in the meantime, make it about 1%. This is a hypothetical 100K portfolio. These are actual trades down here, my trades. But if you can make 1% on your account on the better than the poke in the eye trade, It helps keep the lights on. You put a little bit of money in your account while biding your time waiting for that next big winner. All right, let's shift gears and jump into Mind the Trade. This week, as mentioned earlier, we're going to talk about fear, acceptance, and expectations. And again, we're just going to scratch the surface on this, but I think there's a lot of information that could really be useful here. Now, let's talk a little bit about risk. Trading involves risk, and that's implied. And Merriam-Webster defines risk as the possibility of loss or injury. So by definition, risk means the potential to fail. Now, there's no such thing as a riskless trade. I know there's been some people throughout history who thought so, such as long-term capital management. Therefore, every trade has the potential to fail, and that's something that you have to wrap your head around. Now, backing up a step, what's interesting is that markets have no inherent fear. Now, I've talked about this quite a few times in seminars and also, obviously, in webinars. How stressful was a 2016/17 bear market in cocoa? Well, it was a brutal bear market, as you can see. The market was all over the place and imploded for quite a while, losing over half of its value. And then it just zigzagged back and forth in a very wide and loose manner, which had to be frustrating for traders. But so far, no one has said that they were frustrated. Well, the reason is no one that I've addressed so far was trading cocoa during that period. Now, sooner or later, someone trading cocoa will tell me, yeah, that market really stressed me out. But so far, nobody's been stressed out. So the point being is that a market cannot create pain or fear. Now, this is not to say that there won't be pain and fear in trading. The point is that it comes from within. Now, M. Scott Peck said that absence of fear is not courage. The absence of fear is some kind of brain damage. Now, what he's saying has a very literal connotation. Now, from a neurological standpoint, as I've said quite a bit, you can't make any decisions without emotions. So when they say eliminate your emotions from trading, you can't do that because every decision, even what you could have for lunch today, has an emotional attachment to it. I just had a debate whether or not to eat lunch before I did this presentation or not. If I did it without lunch, I'd be sugar low. If I did it with a full belly, maybe I'd be, have indigestion or something and trying to speak. So you can't eliminate your emotions from trading. That's just one of those other things that you have to accept. You have to embrace them. Now, if you have damage to the orbitofrontal cortex, which is your loss avoidance system, and that's where your feelings about losses come from, then you would be a really, really bad trader. Damasio's research implies that people need feelings to signal when to avoid losses in risky environments. And this all comes from The Investor's Brain, which is a great book on trading neurology. I know you want to party with me. If you go to davelerner.com/books-2-read, you can get a list of all these books, including that one, that I would suggest that you read. The bottom line is there will be some sort of fear in trades. You just have to learn how to manage those fears. And I'll give you a few things to think about when it comes to that in just a few seconds. You always get something really good out of Mark Douglas. And he said, what you fear is not the markets, but rather your inability to do what you need to do when you need to do it without hesitation. And this is probably where I first came up with that cocoa chart, because cocoa, so far at least, has not caused any fear to anyone that I've crossed paths with, even though it was a brutal bear market. Now, as I preach, with any decision comes emotions. That's biology. But if there is excessive fear, and I just said there will be fear no matter what, but if there is excessive fear, channeling Douglas, we haven't fully accepted the consequences of our decision. Or there's something that we need to know to make better decisions in the first place. Now, that's suggesting a knowledge gap. Now, we talked about knowledge gap over the last several weeks, and basically, you think that if you knew more, you could eliminate all losses. Well, you can't eliminate all losses, cannot. On a losing trade, a knowledge gap will lead you to believe that if you knew more, you could have avoided the loss. And go back and look at the show that we did a few weeks ago where we talked about the knowledge gap. So once you have a conceptually correct methodology, stress over a knowledge gap means that you are assuming that there is a holy grail which does not exist. So you think, if I only knew more, I wouldn't have had that loss, but losses cannot be avoided. So you'd have to know everything about everybody and what everybody's going to do. And obviously, you don't know that. We're trading traders, not markets, right? Now, channeling Douglas, after putting on a trade, if there is angst or animosity toward the market, you have not fully accepted the risk. I cuss and I fuss. I don't do that quite as much with the position trading because I have fully accepted the nuances of the position trading. And one way to solve for being super angry lately and super stressed lately is that I've traded less and less, especially on a position trading basis, because they just haven't been any great setups out there. I was going through some old presentations a few days ago, and I forget exactly what time period it was. I could probably look at the markets and tell you exactly. But there was one time period where I went 52 days setup to setup entry. In other words, we had a setup trigger, and then it was 52 days before there was another setup that triggered. And in the meantime, there were a lot of days, especially like lately, where I didn't recommend any setups whatsoever. And that's to avoid putting myself into a state of frustration, and my clients too, of course. Now, let's take a step back and talk a little bit about setting the initial protective stop. And that's going to help us to kind of gauge the risk, obviously, on a trade. Without going into a lot of details, when you boil it all down, there's only two questions that you need to ask yourself. What's the normal noise of the market, and where would you be flat out wrong? Where would that position have failed based on the setup? Now, it is a bit of an art and a science, and I've spent entire presentations just on stops alone. But the bottom line is it has to be outside of normal noise. Otherwise, you're virtually guaranteed a losing trade. Let's say you're looking at a market that bounces around 3 and 4 points a day, and you're like, well, I'm going to try to take a position trade in this, but I really only want to risk 1 point. Well, I can all but guarantee you're going to lose on that trade on noise alone. Now, when it comes to stops, again, we're just trying to kind of talk a little bit about the different types of risks there is out there and the risks that you must wrap your head around. The other thing is when you are looking at a setup, and a first pullback after a base breakout gives you a really good idea of this as far as position failure is concerned. Let's say you trigger into that and then it comes all the way back in to the base. Then obviously it's no longer in a trend, it's back in the base. You are wrong and you have to exit the stop. Now, if you're just trading a generic pullback, your stop can't usually be right below this low here, because the normal noise of the market might make it easy for that stock to dip below that low before taking off once or twice. Your timing might be a little off, and usually it is. Sometimes markets take off in their own time frame, or they always take off in their own time frame. So when you're looking at the market to trade, provided, of course, you pick the best setups to begin with, and I'm going to circle back to that in a few minutes, your expectations must be managed. There is a risk of loss on any trade, regardless of how well thought out. Now, as I often say, not to digress too far, imagine that, if you think you have the mother of all trades and you lose on that trade, and you look back at it during your post-mortem and you say, you know what, if I saw that trade tomorrow, I would take it again tomorrow. I know I've said that 1,000 times, but that's when you sort of get the true enlightenment when it comes to markets. A lot of times you'll think, what the hell was I thinking? And I'll get back to that in just 1 second, but that's okay too. That means that you want to get better. Now, the noise of the market as I said a second ago, must be accepted. Let's say you want to trade S&P futures and you want to try to hold on to them all day. Well, they're bouncing around 30, 40, 50 points a day. You can't go in and use a 5-point stop and think that you're not going to get stopped out just on noise alone. Now, again, your stops need to be at a level where you're obviously wrong, no questions asked, and that must also be accepted. So it's not about what you want to risk in a market, it's what the risks of the market are, what the risks the market suggests, I should say. So again, if there's any animosity toward the market, you have not fully accepted the risk of the trade. Now, I just grabbed this slide because I needed the layout, but as I was reading it, I thought it'd be worth leaving in. The more we understand about the interacting forces behind our own behavior, and that is trading psychology, trading neurology, our wants and needs, all of our extraneous influences, all the influences that are extraneous to the market that we allow to affect our trading decisions, and all the interacting environmental forces outside of us, the easier it is to fulfill our needs and achieve our goals. Now, if you can't accept the monetary risk of a stop that's wide enough to accommodate the noise and volatility of a market combined where you would be wrong, then you need to do two things. Number one, reduce your share size. You have to get the repetitions in. Now, sometimes that means reducing your share size down to a size that's almost meaningless. And that's okay. And I've crossed paths with a few traders over my career who have been involved in the trading education business, not on the front end of it by giving presentations, but more on the back end of things. And in these cases, these traders have become fairly successful fairly quickly. And it's not because they had all the education. Everybody has all that same education. It was more so because they came into the markets and traded at a very, very small size. I remember one case in particular many years ago, and the guy was instantly successful, and I was kind of blown away. And he's like, well, settle down, Dave. I'm only risking $20 a trade or $50 a trade or whatever it was. And he was just slowly getting the reps in, and that's how he became, what to my amazement, a really good trader really quick. The other thing, of course, is pick better stocks or other markets. And there's a whole reason, and it's something I didn't want to get into too much this week, but there's a whole reason why we do tend to pick mediocre stocks. And that's because if you are a trained professional, a doctor, a lawyer, or an automatic transmission mechanic, you are trained to take whatever train wreck comes along, or you have to take whatever train wreck comes along. You can't pick and choose your clients. And this reasoning comes from Dr. J, who's a client of mine. She's a psychiatrist. And when I kept asking every week, why do people pick such mediocre setups, people who should know better? And that was her answer. That's a short-winded version of her answer. Now, one thing that kind of dovetails into current conditions, and it's probably my own frustration coming out in this, is that part of the fear and angst now is created by trading in less than ideal conditions. So let's take a look at the S&P 500, and let's start going back in time a few weeks, a few months, a few quarters, and nearly a year, and you could draw a horizontal line and see that the market on a net basis has not made any progress. In the past, I've called this the Rip Van Winkle sleep test. Imagine that you looked at the market's prices and then you went off for 3 weeks, 3 months, or 3 quarters, whatever the case may be, and came back and picked up a newspaper and you looked at market prices and you're like, looks like nothing's happened in the market. So we're kind of in one of those cases where nothing's happened. Now, that's not to say we didn't have zigs and zags, which adds to the frustration. We had plenty of those. You can see it's up, it's down, it's up, and it's up, it's down, it's up, it's down, it's up, it's down. And if you drill down even further, in between those ups and downs were a lot of ups and downs on a micro basis. Now, when you look at a daily chart, it becomes a little bit more evident. And this is just closing prices now without all the intraday highs and lows. And you can see it looks a lot like an electrocardiogram. That's one thing I preach against As a trend follower, you don't want to be in a market that looks like electrocardiogram. So if you're having trouble trading lately, it's not you, it's the markets. But it is you if you're trading those markets. So it's always your fault. That's the bottom line. But it's your fault for trading in less than ideal conditions. Ideally, we want this market to break out one way or the other and begin to trade. Now, as I often say, I never want to give you a problem or present a problem without a solution. And this week I was thinking, well, the answer to the problems when it comes to fear and expectations and managing our expectations is we really need to document what's going on. And then as I began to put the slide together, I noticed I had a slide left over from last week and probably many weeks prior. As I preach, you need to do a post-mortem after every trade. And that's where you go in to look to make sure that what you saw when you put the trade on is the same thing that you're seeing now. Now, you have to eliminate any hindsight bias, obviously. But a lot of times you're going to be shocked and think, as I said earlier, what the hell was I thinking? The trend wasn't that great. The setup wasn't fantastic. The pullback wasn't deep enough. There were gaps against the setup and other trend qualifiers, as I call them, against the setup. So one way to avoid some of that future angst, as I often say, is time travel, is do the pre-mortem as if you were explaining the stock to someone after the trade was completed. Now, obviously, you don't know how it's going to end up, but you can say, hey, I took this trade because. Now, if you're in an office by yourself and you have no one to explain things to, then talk it out loud. And if you look at every trade that I recommend in my trading service and then subsequently take, and you can look at those at davelandry.com/archives, you'll see that I explained why I'm taking the trade. And that one extra step sometimes slows me down from taking a mediocre trade. So write your pre-mortem as if you were explaining the stock to someone after the trade is completed. How many times have you taken a trade, lost money, and then said, I knew I should not have taken that trade because the trend wasn't there, because the setup wasn't that great? Well, you knew this all along. So again, write that pre-mortem as if you were explaining the stock to someone after the trade is completed. Also, again, time travel and decide whether it was a must-take trade or a mistake trade. So this makes life a lot easier for you before you actually take the trade. Look at it, and if you're not feeling F yeah, and that's the bottom line when it comes to a litmus test, if you're not feeling F yeah, then don't take the trade. And again, write all these things down. As I preach, the extraneous influences can really have a huge impact on your trading. So talk about those things daily in your morning pages. These are just for you, although my daughter did find mine once and got a little pissed off, but that's a story. That's another story altogether. But make sure you keep them private, obviously. But these are just for you, and you can talk about what's going on in your life and be really candid about it. Obviously, in your trading journal, you need to say why you're taking these trades. Point out if there's any extraneous influences. As I often say, if I'm doing any intraday trading, I always write WITO when I walk in the office, because usually I left the office because I was hungry and I walk back in with a full belly, and sometimes just feeling good will make me want to take a trade, an unnecessary trade, that is. What you did, obviously, your emotions at that time, what you didn't do, of course, and of course your emotions at that time. When I do stupid stuff, especially if I know I'm doing stupid stuff, I'll write shame in the margins. Years ago, after attending Charlie Kirk's trading retreat, I was the guest of honor for that a few years back. One of the guys talked about having what he called a shame notebook, and I tried that for a while, and now I just incorporate it into my digital notebook. But if you do something stupid, and especially if you know you're doing something stupid, write shame in the margin, and after a few of those, or a few hundred of those, you become the definition of insanity, doing the same thing over and over and expecting a different outcome. The other thing is, what commitment devices can you put into place to become better? Instead of watching a screen and getting sucked into a market early, or just as bad, exiting a market early and then watch it take off without you, look to put some sort of commitment devices into place. Let's say you really, really like a setup and you're position trading, then put in a hard stop at where you enter that market and then go about your life. And there's plenty of other commitment devices that you could do. And one of my simple ones, like I just said, was I write walk in the office, make sure I take a deep breath, make sure I really analyze any trade that I want to take just because I ate lunch and I'm feeling good. Well, that's all my time for this week. If you need some follow-up information, again, DaveLeonard.com/StockCharts. If you need to reach me, DaveLeonard.com/contact. And join me each week for a live webinar at DaveLeonard.com/webinar. And again, Twitter is @TFollowingMoron. I want to thank everybody for watching, and may the trend be with you.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.